So in this video, I want to talk about some tax planning traps and opportunities for big law associates. If you're a first or second year associate at a large law firm, you're likely earning more than you ever have, and you're facing a tax situation more complex than you may realize. The decisions you make right now can mean the difference between a nasty surprise and a well-managed tax bill. Let's walk through what you need to know. The first major trap that catches many big law associates off guard is bonus withholding. When your firm pays out your year-end bonus, the IRS requires withholding at a flat supplemental rate of just 22%. But if your total compensation puts you in the 32, 35, or even 37% marginal federal tax bracket, that means a significant portion of your bonus is being under-withheld. The result is a large, unexpected tax bill in April, and I see this time and time again, over and over. It's often in the tens of thousands of dollars. The fix is to act now. Either increase your W-4 withholding or make estimated tax payments, or set aside the difference in a high-yield savings account so you're not caught off guard when it comes time for tax filing next year. Now, next, let's talk about the backdoor Roth IRA. One of the most powerful tax advantage strategies available to high earners is the backdoor Roth IRA. As a big law associate, your income almost certainly exceeds the direct Roth IRA contribution limit. But the workaround is you can contribute to a traditional IRA on a non-deductible basis, meaning you're not getting the upfront tax deduction for your contribution. But then you can take the second step of converting those after-tax dollars to Roth. So you add to the traditional IRA, you don't get an upfront tax deduction, but then you convert those dollars over to a Roth IRA, and that is known as the backdoor Roth IRA strategy. In 2026, the contribution limit for IRA contributions is $7,500. It's more if you're over age 50 and can make catch-up contributions, but for most associates, the limit's going to be $7,500. The key deadlines are that you need to contribute by April 15th for the prior tax year. So if you want to make a 2026 IRA contribution, your contribution is due by April 15th of 2027. And then you can complete the conversion whenever you want in order to get those dollars from the pre-tax traditional IRA account to the Roth IRA account. The big hurdle here and warning is that there is a technical thing called the pro rata rule, and essentially it can make these backdoor Roth IRA contributions tax inefficient if you have other pre-tax dollars in IRA accounts. You can't just cherry pick the after-tax contributions that you're making right now if you have existing pre-tax dollars in IRA accounts already. So you've got to talk to your tax advisor about this strategy if you want to go for the backdoor Roth IRA contribution. The 4 slides covering the 401k, and there's important updates for 2026 that you need to know. The standard employee contribution limit is increasing to $24,500. If you're between ages 60 and 63, you'll qualify for a new super catch-up contribution of up to $11,250. That's a pretty significant boost. Additionally, under the Secure Act 2.0, if you earn more than $150,000 as a single tax filer, your catch-up contributions must now go into a Roth 401k. So if your prior year W-2 shows more than $150,000 in income as a single filer, then you have to make your catch-up contributions as Roth contributions, meaning you're not getting the tax deduction for making those contributions. Make sure to update your payroll elections to maximize the limits before we get too far into 2026. Now let's look at your 2026 tax calendar so you can stay ahead of every deadline. In January, you should have reviewed your prior year withholding and set your W-4 for the new year. If you haven't done that, go ahead and do that now. By April 15th, you should have either filed your tax return or filed an extension and made your payment that you believe that you owe. If you haven't done that, very important to get on top of it. You need to have made your prior year IRA contribution for 2025 if you wanted to do that. and pay your first estimated tax payment if you are an equity partner being paid K-1 income and needing to make estimated tax payments. June 15th is the deadline for your second estimated quarterly tax payment. September 15th is the third estimated payment. And then by December 31st, you're going to want to make sure that you've maxed out your 401k, made any final charitable contributions that you want to make, particularly if you're looking to get a tax deduction in that tax year. And then your fourth quarter estimated taxes, we do January 15th of the following year, so 2027 in this case. Planning around these dates proactively will help you avoid penalties and stay on top of your obligations. Managing taxes as a Big Law associate is a full-time job on top of your already demanding career. That's where Concert Financial Planning comes in. We specialize in exclusively working with Big Law attorneys, so we understand your unique compensation structure, your student loan considerations, and your long-term wealth building goals. Rather than applying generic financial advice, Concert builds a personalized strategy tailored to your specific situation, from tax optimization to investment planning to financial independence to changing careers. Delegating this to a specialist like us means that you can focus on your clients while your finances are handled with the same level of expertise that you bring to your own work. To wrap up, here are your 4 key takeaways. First, check your bonus withholding now. Don't wait for a surprise in April. Second, fund a backdoor Roth IRA before the contribution deadline to take advantage of tax-free growth. Third, update your 401k elections to maximize the new 2026 limits, including the super catch-up if you qualify. And fourth, consider working with a financial specialist who understands Big Law compensation. Tax planning isn't just about filing a return, it's about making strategic decisions throughout the year that protect and grow your wealth. Start today.